We're starting. This is Hangouts on Live. This is Ida Tuttle with Presents Preparation for the Enrolled Agent Exams as a series. I'm just going to be every week and talk about what we need to study for the EA exam. Hopefully it's going to be a lot of fun and we'll have some viewers. Okay, let's go ahead and start here. We're going to be preparing for the enrolled agent exam. It's one of those fun exams that you take, although it's a lot better than when I took it. It's still a challenge to take. Some of you were with me last summer, and I promised you that this will be a very different experience this year. I'm excited about the new approach. After the event, the information will be available on YouTube. So if you miss an event or have a question about something or just want to review, you can look at the video again. The class is free. However, I'm going to be developing some handouts, and those will be available for a charge. I will add something to each hangout that is not available in the class. This is a bonus. So the handouts are going to have a little bit more than what we cover in class. They're not going to be expensive, but I haven't determined the price for them yet. As a reminder, the test is taken in 3 sections. The first section is on individual returns. I'm going to start there. The second section is on the business returns, including corporations, partnerships, and LLCs. And actually, we're going to skip that and do that last. Because the third section, which is the final section, is on representation, practice, and procedures, actually blends very well with the first one. And you don't have to take the series of tests in any order. You can take whichever one you want to. It's not a problem. You just have to pass it. As of last year, same as last year, we're going to be using the IRS publications for our information. I still recommend that you get tapped into an online question practice format. The more questions you answer, the better. Fast Track Academy has a contract with H&R Block if you work with them. So you can talk to your district manager and they can see what they need to do to click you into that. With each class, we're going to have a teaching session. We take some time to answer questions that you are having in your studies. And if you have any questions that you can't figure out, then bring them in, and we'll talk about them. The reason I had the question and answer is if you want to type something in ahead of time, then it's easy to do. And we've got it available. Okay. Now, I'm going to do some questions too, and I've got a few books that I use, but I found an interesting site for questions, and that's on LinkedIn. If you're a member of LinkedIn and you are in one of the tax professional groups, sometimes they have questions that are very good, and you have the opportunity then of being able to answer them. And guess what? We're going to have some of those. Because I thought they presented this, well, no specific answer has been given. They present interesting things that we need to think about, both on the test and when we're in real life practice. And I want to be able to extend what you're doing. We're also going to be talking about tips on test taking. What do you need to do to be able to take tests? Some of us haven't taken tests for a while, and it's a little bit scary. But you know what? You can do it. If I can do it, you can do it. And I even left one test an hour early because I got messed up at the time. So it's possible. I'm going to introduce myself to anyone who doesn't know who I am. My name is Ida Rowena Tuttle. I go by Ida Rowe on the go because the business I do is a tax professional, and as bookkeeping, I go to people's homes. I work out of my house the rest of the time, but I go to people's homes. And I love it. So I've had over 15 years experience as a tax professional, doing just one person after the other in business, in the office. So this year was a real fun for me when I was able to go to people's houses. I'm a bookkeeper, an instructor, and over 10 years as an enrolled agent. I discovered late in life that I really enjoy taxes. I like helping people and helping people learn about taxes and figuring out what the numbers could do. This past February, after over 15 years with H&R Block, I started my own business doing taxes and bookkeeping. It's Ida Rowe Accounting Service, Tuttle Accounting Services. I'm sorry. As I can say, all I can say is what a difference. For the most part, I enjoyed a whole lot more than working with the company office or even a franchise. The last few years I was at a franchise. One of the reasons I teach this course is it helps me stay current with what is happening in taxes. We get changes every year. I have a real heart for learning and teaching. So this is my opportunity to do both. And I hope you'll join me for the duration. And one of the things that's doing this as a Google Hangout is if you miss it, it goes on YouTube and you can watch it on YouTube. So that should be a great way of catching up with things. Or you can share it with your friends. Say, hey, I was studying this and I think it's kind of interesting. Well, at this point in time, I was going to introduce my viewers, but I don't see any. So hopefully you'll be there sometime. But then this is an introductory session. So just a reminder, when the class goes to over 9 persons, then some of you will not be on screen, but you can ask questions and make comments using the Q&A section. I would encourage you to invite your friends who are also studying for the EA exam to join us. This is not about questions and answers, but about helping you develop the skills and confidence to take the exam. When I studied for the test years ago, I was in a study group, and it helped keep me on track. And I got insights that helped me pass the exam. And I want to do the same thing for you. All right. So that's the introduction. So what are we going to talk about today? Well, the first thing we're going to do is start with individual taxes. And one of the books that I use quite frequently is the Passkey EA Review. I just happen to really like this one, so I'm going to use this today. Because some of the things it says at the start I think are important. For example, how many of you, when someone is new to your office, do you ask, would you please bring in your previous tax return? And they do. And do you look at it? And when the tax preparation is over with, do you then review it so that you can look to see what was missed and what wasn't missed on your return? If you don't, then you're not doing them a service. And the IRS really would like for you to make that review. I'm going to try something here. All right. So one of the things that it says, I'm going to have to lift this big book up here. We are expected to perform due diligence in collecting, verifying, and gathering taxpayer data. Preparers are also expected to review prior year returns for compliance, accuracy, and completeness. A tax practitioner is required by law to notify a client of an error in a prior tax return and the consequences of not correcting the error. However, a practitioner is not required to actually correct the error. You don't turn them into the IRS. The use of prior tax returns help to prevent major mathematical errors in the way of the tax preparer to issues specific to the particular client. In reviewing prior tax returns, practitioners need to determine whether there are items that affect the current year's returns, including the following: carryovers, net operating losses, credit for prior year minimum tax, and depreciation. Okay, so those are some of the things that we're looking at. Many of our clients don't have things like that. When we do, we need to be especially careful and make sure that we've taken care of everything that we can. And sometimes we see things that just gives us the opportunity of asking questions to gain know more about our clients. And because people have misinformation, and sometimes that misinformation is not only provided by other tax professionals, but it shows up in the return, and we need to help correct that. So that's the first thing we need to do. So we're going to look at the prior year return. So the government expects us to do that. Now, the first thing we gather is the taxpayer's biological or biographical information. We want to know their legal name, as it is on their Social Security card, their date of birth, their marital status, their residency status and or citizenship, dependents, tax identification number. Well, not my first year, I went over to another office because they were short-staffed. And many of the clients were Latino. Well, I don't speak Spanish. So I had this young lady that came in, and as I asked all of my clients, are you a U.S. citizen? Are you a resident alien? And when she left, the guy that was there in the office came over and says, we don't ask our clients that question. And I thought, okay, the government wants us to. I'm going to ask the questions because I want to say whether I don't care what you are, because it doesn't show up except on the kind of form that you need to use. If you just got to the country, you haven't been over here a year, you're probably going to be a non-resident alien. If you don't have the green card, you just say yes. Doesn't make any difference because when you look at what goes up in the tax, that doesn't show up. I'm not going to turn anyone to the INS. But we are supposed to determine that. So you can't make up your own. This is not one of those things where you make up your own mind. Now, when we talk about a valid identification number, you can be a Social Security number, but there are two other forms that they can use. One is an ITIN number, or ITIN, and the other one is an ATIN. The first one is for people that come into this country, they don't have a Social Security card, so they can file and get a special identification number for them. It works as a Social Security number, however, it does not give them permission to work in the United States. In fact, if you see that on the Social Security card, it'll say, does not give you permission to work at the bottom. And the ATIN is the adoption tax identification number for parents who are claiming children that they're in the process of adopting. The adoption is not finalized yet, and so you can't get them a Social Security number. When it is finalized, then you can go ahead and get them a regular Social Security number. The number that they got at birth will be changed. So keep that in mind. How many of you are aware that the ITIN procedures over the past few years have changed in 2013? It used to be we could make a copy of the passport and tax ID, the driver's license and all that. Well, now the government, in all of its wisdom, decides that they want to see the original documents. So they have new procedures. It must include the original documentation, such as passports and birth certificates, or certified copies of these documents from the issuing agency. Well, if you're from Canada, you're not going to go back to Canada to get, unless there's a Canadian office here that you can do that. So you're going to end up sending in your passport. And if you're planning on leaving town real soon, it becomes a little bit conservative. Notarized copies can no longer be accepted. Military spouses and military dependents are exempt if they provide a copy of the spouse's or parents' U.S. military ID, or if they apply from an overseas APO, FPO address. Non-residents aliens applying for the ITIN for this purpose of claiming tax treaty benefits are also exempt from the new requirements. But the IRS says it will give heightened scrutiny to any documents identified by these applicants. In other words, if you don't, we're going to check you a little bit closer. All right. So, the next thing we're going to talk about is record keeping. Ooh. Record keeping? Okay. What do you need to do for record keeping? Well, first of all, some of our clients we know don't do a very good job. But one of the things that we're learning is as the IRS is more computerized, they are able to come back and look at things and want to see documents and understand things a lot more. So what do you have to do? Well, first of all, I recommend that you first of the year, not just at tax time, but first of the year, you start getting a file and you put in all the tax documents that you need for the year. So when you come in and the first time you see someone, especially now with the new rules in earned income credit, which we'll be getting to later on in a few series, it says that we want to use the I forgot what I was going to say. All right, we need to see your uh, Social Security or identity card that says that you are who you are. And if it's a child, we need to see school records or something that proves that they are in school or that they are legitimate children, or medical records if it's from a doctor, if they're not in school yet. So they need these things in order to be able to prove that the child is actually theirs, especially if they're going to be getting earned income credit. If they're not getting earned income credit, it probably doesn't mean as much. And you don't have to worry about asking. If a parent is making $60,000 or $70,000 a year, you don't have to worry about it because you're not going to get earned income credit anyway. So it's just the ones with lower income. And, no matter how you feel about it, because we have to do what the government says. We have to look at that. A lot of people are feeling that we're doing the government's job. Maybe we are, maybe we aren't, but there's been a lot of fraud in this area, and I think what they're trying to do is to cut that down. If you've ever had a client that's gotten caught up because someone used their Social Security number, you know that it hurts people that are innocent, and we don't want that to happen. So you have to identify the sources of income. All right. Most of the time you have a W-2. Some days you get a 1099. Sometimes you get an interest form, you get a dividend form, you get if you have a partnership trust, a K1. So there's all different ways you get income. But sometimes you don't. You're self-employed. Well, now they have this new thing out where the credit card companies are going to send you what you made on credit cards. But you have to be able to document where your income was. And that includes cash. And by the way, it's not just cash that's legitimate. It's someone is paying you under the table, they're paying you over the table. It doesn't make any difference. Whether it is legal or illegal, it doesn't make any difference. There is no exception to the rule. If it's barter, which means that you exchange services with someone, both of you then have income and you also have an expense. So it may just wash out, but you have to claim that income. All right. Then we need to keep track of expenses. Those are things that we need to keep track of that can be deducted. Now, it's going to be harder for people that itemize their deductions, who have medical expenses, to be able to claim that now because it's gone up to 10% of their AGI before you can even begin to claim medical expenses, unless you're 65 or over. And that's just for another couple of years. If you do charitable contributions, you need to have some kind of a record. And if it's over $250, remember that we have to have something from the person or the agency that they gave it to. So that we need to have those documents. And I recommend that when you get the documents, one of the things that you do is you Okay, I'm looking at my needs. And what you want to do is you want to, you want to make a copy of it on the computer. So it's a digital copy. Okay, we're going to make digital copies of all the stuff. So at the end of the tax year, we have all that stuff put together, and we can bring the originals into the client, into our tax profession, or we can bring in a thing that says, okay, these are the this is the digital things that I have done, and this is what we're going to do, and see what happens. If you get audited, the government is willing to accept the digital copies. However, you still do not throw away the receipts. You still need to keep hold of them because those are important documents. I heard someone talking about, they just scanned. That's what I was thinking about. They just scanned all their documents and threw the receipts away. You don't want to do that because the government may want to see the specific document for a particular reason. They want to make sure that the date is on there, where you went. If it's a restaurant, for example, the date, who you went with, the reason why it's a business expense. If it's not a business expense, you can't take it. So you have to prove why it was a business expense. And that's on you because you know what you spent the money for. You have to keep track of property. If you have a home and you do things to your home, you want to keep track of that. Why? Well, sooner or later you're going to want to sell it, or someone's going to inherit it. And what you want to do is be able to determine how much did you actually pay for the house. I paid $200,000 for it. Down over the course of the years, we made about $100,000 in improvements, and with inflation and everything, it's now worth $500,000. Okay, if you didn't have the proof of those, then just what you pay for the $200,000. So then you'd end up having to pay income tax on the amount over $250,000. But if you have that proof, then it's not a problem because they can look at it and if they question it, they can look at it and they say, okay, fine, this is what we need. Not a problem. All right. Now, it's one of the things it says here is good records help taxpayers and their preparers file accurate returns more quickly. That's true. If someone brings in all of their documents and they have them in some kind of an order, then one of the things that happens is it's easier, it's faster to be able to then do the return. I know. One of the things I do in my practice is if you bring in all of your documents and all of your information on your expenses, I give you a 10% discount. Why? I think it's that important that you be responsible enough for your expenses and everything, that you bring them in so that we can put them together and move forward. And if you do that in writing, so that, I don't know about you, but I have so many clients that come in and they look at, well, I think I spent $150 for that. You think? You don't know? Are you making it up? Are you guessing? Or is it just something that happened to pop into your mind? Well, we want to make it accurate. We don't want to do guessing. Because we want to be honest people. At least I do. We need to support the items that are reported on the return, so that the IRS has a question and you do get called in for an audit, you have it there. That's why I like scanning everything. You have everything, you put it in one file, and you know that it's there. And anything happens, you just come pick the thing up, you put it on a floppy disk or whatever you need to keep it separate from everything else, if that's what you want to do, and put it with your tax records, and then you just, you're ready to go. You don't have to worry about it. Well, I know that I have proof. And I've seen what happens when you don't have proof. You end up going into the IRS, you get audited, you don't have proof, and say, I'm so sorry, doesn't work. You're going to get more taxes. You're going to get taxed on it. And sometimes it's because people told you wrong. And sometimes it's because you did wrong. And innocence is no excuse. Okay. Yeah. I'm going to skip to something a little bit different now because I saw it today and I thought it was kind of interesting. Here we go. Some of us may have people that lease cars. They're in business and they lease an automobile. So I'm going to talk about this because I think it's interesting to note. Um, this is from Bradford Tax Institute from their tax reduction letter of June 2014. There are three often overlooked tax deductions when you lease a vehicle. Leasing a vehicle appears to be straightforward. It often is, but you may need some tax knowledge to ensure your rightful tax deductions. Um, all right, we know that you get, when you lease a vehicle, you pay advance payments. You might think of these as down payments, but actually the law calls them rents paid in advance. Lease payments, which you pay every month, and operating expenses. Okay. They ask you for $3,000 down. So you give it to them in cash. You need to amortize that $3,000 over this period of the lease. So if it's a 3-year lease, you're going to amortize it over 3 years, which would be $1,000 a year. If you traded in your old vehicle for as part of your lease payment, that's considered having sold the car to the leasing agent. So whatever that is, that's the sales price. And you're going to then deduct or amortize in equal amounts over the life of the lease that amount. So whether you pay cash or whether you turn in your vehicle, it's going to be the same. Um, and then you have to also look at the difference between, if it's a business car that's also personal, the difference between the two. Because you only can deduct the business portion. You can't deduct the personal portion. So you have to pay attention to that. All right. So you can only deduct the business use portion. And what do you have to do that? Well, first of all, you're supposed to do mileage. In January, you start, you take the amount of miles that you've driven and from the previous year, and you write that amount down. 3,642. Let's say it's a new car. The end of the year, the 1st of January, the next year, you're going in and you're going to get an oil change. And an oil change is a way that, because they write down the mileage for you, so you have a second person verifying the amount of mileage that you drove for the previous year. So they'll look at that, and frequently the IRS will ask for those documents. So don't just throw them away. So you can, because they are part of your business expense, you have to keep track. These are records. So then they're going to look at it and they're going to say, okay, so you drove actually 15,322 miles last year, let's say. And of that, how many were business? Well, you need to keep track of your business miles. And then you also have to keep track of the rest. I mean, it's whatever the difference is. So if you drove 70% of 70% of the time was business and 30% was personal, then 70% of your business expenses are deductible and the other 30% are not. So first of all, the advance payment. Remember what we said? We're going to amortize it. You can't take it all at once. And I have to confess, I don't think I've ever done this. So I know next time that I don't have that many leases. But if it's a first year lease, you want to ask, did you pay a down payment and how much did you pay? And that gets amortized over the cost of the number of months times the percentage that you drove it each year. Trade-in value advance payment. All right. It's just like cash. You sold it to them and that's what it's going to be like. So the value is the same as if you had paid in cash. You amortize the trade-in value just as you do the cash down payment. Okay, so because a trade-in you own is not the kind of a lease of a vehicle, the law treats the trade-in of your own car as a sale to the dealer. So when you sell a business vehicle, you generally have a taxable profit or a deductible loss. If you sell a person vehicle, you pay taxes on any profits and get no deduction for any losses. In this example, you sold a 75% business and a 25% personal vehicle. So 75% would be, if you had a gain, would be taxed. If you had a loss, then you could claim 75% of the loss. Now, the second thing you're going to deduct is your lease payments. And remember that one of the things that the IRS does, and for years was confused about this, and I'm finally getting it straight in my head. They make you reduce your lease payment deduction by a yearly inclusion amount. And I think what confused me is the inclusion amount was always small, or at least it seemed to me to be. The inclusion amount is very low, but they are a pain in the neck to calculate. Yeah, I'll agree with that. And the orange box to the end, okay. So let's say in May 2013, you leased and placed in service a $30,000 automobile. They used 75% for business in 2014. The 2014 inclusion amount is $12. Your lease payment in 2014 is $2,688, which is 300 times 12 times 75% minus 12. Actually, fairly easy once you think about it. You apply the inclusion amount only to luxury passenger vehicles. You do not apply the lease inclusion amount to the following vehicles. All have escaped the luxury classification. Cars with curb weights greater than 6,000 pounds. There are very few of these around. Sport utility vehicles, SUVs, with gross vehicle weight ratings of 6,001 pounds or more, and pickup trucks or vans with gross vehicle weights ratings of 6,001 pounds or more. And then you have your operating expenses. Well, what are those? Well, you have maintenance and repairs, tires, gas, oil, insurance, and that includes gap insurance, parking fees, and tolls. So this means that you need to keep track of all of your mileage, all of your expenses for the car. Every time you get gas, it needs to be recorded as an expense. You may not have to do tires every year, but when you do, or maintenance and repairs, oil, insurance, car insurance, parking fees, and parking tolls. However, you may not take parking tickets or moving violations or traffic school, because those are violations of the law that you got caught for and you can't take them. So let's say that you have 6,000 of operating expenses. Multiply this by your business percentage of 75%, and your deduction for 2014 is 4,500. So by the time you put all these together, your vehicle deductions is 7,938. 6,250 per month times 12 plus 2,688 plus 4,500. Not bad. If you operate a business as a corporation, the corporation owns the vehicle. Special treatment of your personal use can make the business portion 100% deductible to the corporation, as explained. Okay, we'll have that. Why should you skip the mileage method? All right. Let's see what this is. I really liked it when I took the standard mileage. It was so much easier. If you don't operate your business as a corporation, the IRS gives you an easy alternative for the deductions listed above. You can use the IRS standard mileage rate, currently 56 cents per mile for each business mile you travel. If you pick up this method, you have to give up deductions for your down payment, amortization, lease payments, and operating expenses, and use a mileage rate for the entire term of your lease. including renewals. So if you sign up for 3 years, you keep the car for 6. All that time you have to use tenure. You can't go back and forth. So if you use actual, the first year you stay on actual the whole time. Leases don't let you go back and forth. When you buy the car, if you start out on standard, you can change it. The mileage rate method is not a good choice for most leases, but it can work to your benefit if you lease a low-cost car that gets lots of miles to the gallon of gas, and you drive a huge number of business miles. Suppose in 2014 you drove your vehicle 12,000 miles for the year. The 56 cents a mile gives you a deduction of only $5,040. 12,000 times 75% times 0.56. When you compare the $5,040 with the $7,838 in actual expenses calculated above, you gain $2,898 in deductions by using the actual expenses. What are some of the takeaways? The trade-in of a business or personal vehicle on a lease of a business vehicle produces first an amortizable down payment, and second, either taxable gain or tax-deductible loss on the vehicle that you traded in. If your newly leased vehicle qualifies as a luxury car, 6,000 pounds or less, as explained above, you need then to calculate the inclusion amount from the IRS to determine your deductible lease payments for the year. You may not use IRS mileage rates on a corporate-owned vehicle, and you deduct the business part of the vehicle only. Okay, so I just wanted to share that with you today because I thought I had just come across it. I've got some of these really neat sources that I'm having fun with and learning all about. So while we're on mileage, I'm going to get my little mini iPad out because I found something else. Many of my books are on my iPad. So we're going to talk a little bit more about mileage. Okay. We have a lot of clients that are in business for themselves. And they travel for business. So this is Eleanor's business office is in the downtown building. She has no home office. One morning she leaves home, stops off at a client's office to drop off some work, and then goes to her office. The entire trip is deductible because she stopped at a temporary work location on her way to her office. So because their office is a temporary work location, because the client's home is a temporary work location, she gets to take the entire mileage. I also tell clients that if you get a post office box close to your home, then that's your first step, and that makes it all inclusive. And that's only necessary if you don't have a home office. If you have a home office, then the commuting rule wouldn't apply, and the trip would be deductible with or without the stop. If you don't have a regular office, the rules about travel to temporary work locations are more restrictive. Without a regular office, you can deduct the cost of going from home to temporary work location only if the temporary work location is outside your metropolitan area. Artie is a cosmetic salesman with no regular office. He lives in Boston and regularly visits customers all around the Boston area. He cannot deduct any expenses for his local travel around Boston. One day he travels from his home in Boston to New Haven, Connecticut to see a customer. He goes back home the same day. Artie can deduct this trip because he traveled outside the metropolitan area. Okay, what is a metropolitan area? The U.S. Census Bureau has divided the country into various metropolitan areas for its own purposes, but these vary greatly in size, and not every town is located in one. When the IRS attempted to use these Census Bureau areas to deny a taxpayer travel expenses deductions, it was shut down by the tax court that elected to use a common sense definition of metropolitan area instead. Corey Elweir, a union boilermaker who lived and worked in Wisconsin, was assigned to work temporary jobs all over the state, ranging from 1 day to several months, while deducting his travel expenses for jobs further than 35 miles from his home. Weir deducted his travel costs to jobs further than 35 miles from his home. The IRS disallowed his deductions on the grounds that the Wisconsin Ramos was not a metropolitan area as defined by the U.S. Census Bureau. The IRS said that the entire state of Wisconsin should be considered Ware's normal work area for purposes of travel expense deductions. Ware appealed, I don't blame him, to the tax court and won. The judge decided that the U.S. Census Bureau's definition of metropolitan area should not be used because these areas vary greatly in size, and that taxpayers in rural areas would be at a disadvantage to those in more populated areas. Rather, the government adopted the dictionary definition of a metropolitan area: a region including a city and its densely populated surrounding areas that are socially and economically integrated with it. The judge held that Weir's conclusion that he was out of town whenever he was more than 35 miles from his home was reasonable. Unfortunately, the judge's ruling is not binding on the IRS, but it still should provide you with useful ammunition if the IRS claims that your metropolitan area extends more than 35 or 40 miles to your home. Okay. So, this is what I was looking for. We're going to do a little self-test. See if you can figure out how many business miles were driven by each of the following examples. John, a salesman with no home office, drives 25 miles to his downtown office in the morning, works all day, and then drives 25 miles back. After dinner, he drives 30 miles to meet a client, and then drives back home that night. Total business miles, 60. He can claim the trip to his client back and forth because the client's office is a temporary work location for John. Sue is a freelance writer who works from home. She travels 5 miles to the grocery store and then heads off to the library 5 miles away to do research for an article. She then drives back from the library a distance of 10 miles. The total business miles is 20. It's a good example of how you can convert a personal trip into a business trip. She stopped at the grocery store. Normally her trip to the grocery store is not deductible, but her journey to the library is. Because the grocery store is en route to the library, she gets to deduct the 10 miles, 5 to the grocery store, 5 to the library. It's 10 miles back to her house from the library, so she gets a total of 20 business miles. I like this next one. Nick is a bookie who works out of his car. One day he drives 20 miles from home to the racetrack. He then drives 15 miles from the track to each of the homes of 3 customers to make collections. At the end of the day, he then drives 10 miles to get back home. That evening, he drives 15 miles from home to the house of an associate for a business meeting and then drives back home. Total business miles is 15. Because Nick has no fixed business location, he cannot deduct the travel from his home to his first business location or back home from his last business location. Thus, he cannot deduct the 20-mile trip to the track or the 10-mile back home from the customer's house, nor can he deduct 30 miles round trip later that night to the business meeting. He can only deduct mileage of the 2 middle collection points that he has made. Oh, that's too bad. Gloria runs her home construction business from an outside office. She has no home office. One day she drives from home to a site 30 miles away where a company is building a house, and then drives back home at the end of the day. The project is expected to last 6 months. The total business mileage is 60. It's a temporary workplace. Her travel from home to the building site is not considered commuting. So keep this in mind, because if it's a temporary workspace place, then you can take the mileage. And I think that's something that's interesting to note and important to note. So I wanted to share that with you because it kind of gave me a little pause to think and looks at things a little bit different, and I think helps to clarify sometimes. Because you have people coming in and they want to take all kinds of mileage, and sometimes you're just really not sure whether they should or not. This gives you a little bit better idea. Okay. Well, it is 6:52, and since I still have nobody here, I'm going to close for today. Next week, I'm going to continue. We'll see what happens. It's 6 o'clock, so I look forward to seeing you. whoever you are, the preparation of the enrolled agent exam with Ida Rowe on the go. And if Monday night at 6 o'clock you're not doing anything, I have a class called Bookkeeping for Taxpayers and Other Interested Persons, so that when all we're doing is looking at what we can do, what we need to know about bookkeeping so that we can share with our clients and we can help them do better with what they're doing. We're going to be talking about Google Sheets, which is very similar to Excel, and we're going to be talking about Xero, beautiful software for the last 4 lessons. I hope to see you either here or there again next week. Have a great one. God bless.